Hello, all. Welcome to today's session on financial well-being of individuals. In today's session, we are just going to go ahead with the process of ITR filing. We are going to go into the deeper section of how and why what the budget has brought in for the individual return filers, and we are going to have an understanding of the regimes and how to select the ITR forms regarding all the basic things of tax return filings. My name is C.A. Shoykot Roy, and unfortunately, today's session should have been taken by Preeti, but because of some unforeseen event, she was not able to attend today's session. So instead, I'm taking up this session. I'm just filling in for her. Now, let's look at today's agenda, right? So firstly, we are going to see why the income tax return needs to be filed, what will be the updates for the budget, what were the updates in the budget for individual taxpayers. Furthermore, we are going to see what is the benefit for sticking with the old tax regimes, and we are going to understand a little bit of tax saving under 80C, and the ELSS, what are the benefits for it, and we are going to understand in what ways you can save the taxes, which will go beyond standard 80C deductions like your LICs and tuition fees, home loan payments, etc., etc. Now, so firstly, let's look at and understand when should I file the income tax return. Now, as it stands, the due date to file the income tax return for the financial year 2021 and 2022 is 31st of July 2022. Now, this is the due date in which you should file your tax return. However, the government has given you an additional time frame in which you can file the income tax return. The due date for it is 31st of December 2022. Now, this additional number of days, that is the due date of 31st of December 2022, comes at a cost. Because if you are missing the deadline of filing the income tax return before 31st of July 2022, late filing fees are applicable upon you. So the late filing fees can go up to 10,000 rupees and it can start from 1,000 rupees. Now, based on the income you are having, the quantum of late filing fee is determined. So in this context, it's pertinent to remember that in earlier times, the due date of filing the income tax return could have been the last date of the assessment year. That was 31st of March of that assessment year. However, in the last year's budget, not this year's budget, in the last year's budget, it has been cut short to 31st of December 2022. Therefore, if you are missing the deadline of 31st of July 2022, you should bear in mind the latest the income tax return can be filed is 31st of December 2022. Now, here lies another question, that I filed my income tax return before 31st of July, but later point of time, I came to know that I have omitted certain incomes from my income tax return. So in that case, what will happen? If you have missed including certain income, or if you have not filled in certain income details in your income tax return, in that case, an option is offered to you by way of filing the revised tax return. But the revised tax return also must be filed before 31st of December 2022. Right? And the issue, or rather one of the main concern of not filing income tax return is the TDS. Now, in the last year, the year before that, the new provision has been brought in Income Tax Act, wherein it says if one person is not filing their income tax return for 2 consecutive years, then that person will be eligible for or rather penalized by deducting twice the amount of TDS. Now, this amount is applicable for FDs, the dividends, all the other sources of income. It is not applicable for the salaried class of people, but it is, or rather salary income, but it is applicable for other sources of income. So many of us have our fixed deposit, right? And on that fixed deposit, we earn certain amount of interest. As it stands, that at the time of giving you the FD interest, the bank usually deduct 10% of taxes. But if you are not filing the income tax return for 2 years consecutively, then the banks will start deducting 20% on that FD interest income. Therefore, you should be filing your income tax return. Furthermore, if you are going outside India, needed. Also, if you have certain income, if you have paid taxes extra, in that case you are eligible for refund if you have filed your income tax return and if it is processed by the income tax department. So there are multitude of reasons for which you should be filing your tax return. If you are not filing the tax return before the due date, at least try to file the income tax return before 31st of December. Now, having said that, having understood the tax return, the necessity of filing the income tax return, let's try to understand why. What was the changes in the income tax return form, income tax act for the individual tax return filers. Now, as it stands in budget 2022, there was no change in tax slab as such. So the old prevailing tax slab are still relevant to this day. However, there is one option that has been introduced, that is to update the income tax return, which we are going to discuss a little bit later. Furthermore, in this budget, the government has reduced the surcharge on long-term capital gains. Further, they have brought in a special provision for taxation of cryptocurrency, and to elevate the dependent person, to elevate the person who are responsible for taking care of differently abled people. They have brought in certain exemption for them as well. Furthermore, they have relaxed certain COVID related expenses and income, which we are going to look at in the later stage. First of all, let's try to discuss the lower effective tax rate on long-term capital gains from unutilized or unlisted equity shares or any long-term asset as such. Till this date, or rather till this year's budget, if you are selling off long-term capital asset, that is in form of listed equity shares, and if your income is more than 1 CR or 50 lakh rupees or 10 CR, then you are liable for certain amount of surcharges. Now the problem is that if your income is crossing 2 CR or 5 CR, then the surcharge would have been become 25% or 37%. Now the only lesser amount, 15%, was applicable for capital gains, long-term capital gains, that was there in listed equity shares. But there was this disparity because we are at this point of time trying to differentiate between other long-term asset and equity shares of an Indian listed company. Again, to bring to an equilibrium position, the government has declared that for any long-term capital gains, the surcharge will be capped to 15%. They have done with 25% of surcharge and 37% of surcharge. However, it is to be remembered that 15%, this particular provision is applicable for very few people who are earning very high incomes. Furthermore, If you are holding any foreign shares, angel investors, founders, and if you who have ESOPs, and they are selling off their shares, then it is absolutely boon for them, because their long-term capital gains will never be taxed at higher surcharge, that is 25% or 37%. Furthermore, the government in this budget has introduced the taxation upon cryptocurrencies. However, they have differentiated cryptocurrencies and they have called it now a virtual digital asset. A virtual digital asset also includes NFT, that is non fungible token. Now, taxation of cryptocurrencies, still they have some room for our imagination, because they have not explained the entire thing, and still today we are waiting for certain clarification. But what are the headline figures to taxation for cryptocurrencies is, whatever the gain you are receiving, on that gain 30% tax will be applicable. So if you have earned, let's say, 1 lakh rupees upon purchase and sale of crypto assets or virtual digital assets, in that gain you have to pay 30% taxes flat. There is no deduction for any other expenses apart from the purchasing cost. So let's try to understand this situation with an example. Let's say today you have purchased one Bitcoin, you have paid, let's say, 1 lakh rupees. After 3 months, you are selling off that Bitcoin and you are selling it off at 1.5 lakh rupees. So in this case, your gain will be 50,000 rupees. That is 1.5 lakh rupees selling price minus 1 lakh rupees cost of acquisition or purchase price. So on that 50,000 rupees of gain, you have to pay 30% of taxes. And on that taxes, surcharge or cess, that will be applicable at prevalent rates. Furthermore, at the time of disposing, you are purchasing the virtual digital assets, that is VDA. TDS need to be deducted at the rate of 1% before you make the payment. So in crypto exchanges, let's say you and I are present. I am purchasing certain virtual digital asset from you. While making the payment to you, I will be deducting 1% taxes and I will be paying that to the government. Now, you at the time of filing the income tax return claim the credit for tax that has been deducted and show the gain in the income tax return. Furthermore, there might be certain commission charges or certain brokerage at the time of selling of these virtual digital assets. Now, those are not deductible as such, only the purchase price can be deductible. Also, if your income is falling below the basic exemption limit, and this virtual digital asset transaction is the only source of income you may be having, the unused basic exemption limit, that is up to 2 lakh rupees, you need not pay any taxes. That particular segment of income tax act will not applicable. So even if your gain from trading of crypto virtual digital asset is coming to, let's say, 40,000 rupees or 50,000 rupees, you need to pay straight away taxes at the rate of 30% on the entire gain. Just because your income is below 2.5 lakh rupees, it will not be taxed. This situation does not apply for virtual digital assets. Furthermore, this is a really beneficial update for the income tax department, from the income tax department, wherein it says, if one person is a differently abled person, and that person is dependent upon certain family members, the family members, they can take up some insurance to maintain those differently abled person. However, if the insurance policy they have taken to maintain that differently abled person are to mature, that amount could have been taxed in the hands of recipient. If the person would have died, then the amount would not have been taxed at all. But in the lifetime of that person who is taking care of that different abled person, If he has received that amount on its maturity, the insurance policy's maturity, then the income, the amount that he has received would have been taxed in his hand. However, there has been an amendment wherein it says if the person who is supporting the differently abled person received the money during their lifetime, and that person who is supporting is over 60 years of age, that is they are senior citizen, that income will not be taxed in their hand. So this is a very useful tax saving option provided, much needed tax saving relief provided towards the senior citizen person who are taking care of differently able dependents. Further, COVID expenses and COVID and testing time for every one of us. We have lost many people. We have lost many people because of the pandemic that has been going on. Right now, pardon me. Yes. Due to this pandemic, we have lost many of our people, many of our near and dear ones. But till last year, there was no update if we have received any compensation or any aid for the treatment of COVID, or if we have received any amount due to passing of our dependent or rather our relative who has passed away due to COVID. Now, from this year, or rather from this year, this particular section has been enacted and it is being effective retrospectively, that is from 1st of April 2020. If one person has received an amount either for treatment of COVID or because the person has died of COVID, in that case, the amount will not be taxable in the hands of the recipient, provided the amount is not crossing 10 lakh rupees and the amount is being received within 12 months of that incident, that is admission to the hospital or in case death, the death of the person. Also, if the employer are choosing to reimburse the amount for COVID treatment in hospital, then the amount received in the hands of the employee will not be taxed. Again, the limit is there. However, if the employer is maintaining the hospital in which the COVID treatment is taking place, in that case, the amount of medical expenditure will never be treated as perquisite in the hands of employee. So again, that is a very important and welcoming tax exemption and tax relief provided to the employees. Before moving on to understanding the tax regimes and everything, let me just quickly go through the updated tax return filing segment of the income tax. Now, for the last few years, if we are missing out certain details, if we are missing out declaring certain details in our income tax return, we used to get a SMS from the income tax department stating that there are certain transaction that has happened in your account. Please update the tax return as it needed. However, due to the passing of the due date, there was no way we could have done that, because the tax return filing, even though if it is belated or revised, that would have been ended on either 31st of March or 31st of December for the matter. That actually created a lot of headache and problem for the taxpayers, the assessees. Again, to alleviate this situation, the income tax department has come up with a new ITR form, which is ITR-U. Now, under ITR-U, what you can do is you can update your income tax return. So it will be taken as annexure to the original return that you have filed. Only the additional income which you missed to declare, that will be added to your original income tax return. However, there are certain catches to it. Number one, if you are filing ITR-U, in that case, your income should increase, or income should increase. After filing ITR-U, your income should not decrease, or your losses should not increase. Furthermore, your refund amount, if any, that was there in original income tax return filing, it should not decrease as well. Therefore, the department is only allowing you to file ITR-U provided it has the effect of increasing your income. But the trouble with this is, if you are filing the ITR-U, the department is going to claim an additional amount of taxes from you. This amount, this new tax rate is only applicable. The older normal slab rate will not be applicable for updated tax return, in which you are updating the interest income which you have missed to file during the original returns filing. Now, having understood that, let's move on to understanding whether the new tax regime is beneficial for you or not. Now, as per the data last year, data that was used to file the income tax return through our website, only 10% or less than 10% in fact, filers has opted for new tax regime. Now, the issue with the new tax regime is that even though the tax rates are offering lesser amount of tax rates, the slabs are much closely stacked together, but the assessees has to forego all the exemptions. For example, the HRA, the home loan, the LICs, EILSs, mediclaims, all the standard deduction, the professional taxes, all those deductions they have to forego. Only one benefit of deduction is available, that is for NBS. Now, if you are in dilemma whether to go for the new tax regime or old tax regime, we will understand what is in store for you if you opt for old tax regime. But if you are planning to invest a little time and research and willing to invest the money into some certain instruments, then you can save a lot of taxes. However, new tax regime is applicable if you need more cash in hand. Simple as that, because there is no deductibles and etc. So the amount you are earning minus the tax you are paying, whatever the amount is there. Investment, if you are paying rent, if you have home loans, all these things, it might be better for you to stick with the old tax regime. Pardon me. Now, let's try to understand how we can reduce the tax outflow by significant margin if we opt for ATC, if we are looking into old tax regime. First of all, if we are assuming basic salary of 20,000 rupees per month at the rate of 12% of contribution towards employer provident fund, you can invest 28,800 rupees. Further, if you are doing a SIP of 8,000 rupees per month into ELSS, 96,000 rupees you can save. And if you are paying LIC premium of, let's say, 30,000 rupees a year, you are investing in total of 1,54,000 rupees under 80C. Now, maximum amount that is eligible is 1,50,000. So 4,500 rupees will not be useful anyway. However, on that 1 lakh eligible 1,50,000 rupees, if you are falling within the tax bracket of 30%, you can save 46,800 rupees easily. So on 1,50,000 rupees, 30% tax is 45,000 rupees. 4% on top of that, that is 1,800 rupees, and you can save easily 46,800 rupees, 46,800 rupees if you opt for the old tax regime. Now let's try to understand why should we save the taxes via ELSS. Now ELSS is a very attractive new tax saving instrument that is that has presented itself in a much more good form instead of the tax saving FDs. Now, what are the key difference between the ELSS and tax saving FDs or any other tax saving instrument for the matter? So first of all, ELSS has a very small lock-in period as compared to other instruments. So for example, for tax saving FDs, the minimum lock-in period is 5 years. But for ELSS, the lock-in period is 3 years. That means if today, or rather if 1st of January 2022, if you had purchased a ELSS, you must hold it for 31st of December 2025. After that, you can sell it off and you can claim, you can show any gain that you have received as capital gains. However, for the tax saving FDs, you had no other option to wait for another 5 years. So if you had taken a tax saving FD on 1st of January 2022, the lock-in period would have been 31st of December 2027. So it gives you a quicker time to liquidate your asset. Furthermore, ELSs are mostly equity based, or they are all equity based. Therefore, they give you a much competitive return as compared to other traditional tax saving instruments. The returns can vary between 12 to 15% depending on the situation. However, if we look in the tax saving option of tax saving FDs, the expected return is much lesser than the amount that is, or the return, that percentage that is provided under ELSS. Further, you can choose to invest in SIPs in ELSS, or you can just go ahead and put a lump sum amount in ELSS as well. Whichever way fits your bill, you can go with it. However, for the tax saving FDs, you need to invest the entire sum of money at one go. And finally, investing in ELSS is mostly an online process. There is no need for you to visit the broker. You can easily opt for ELSS through online mode. Now, since we have looked in the benefits of ELSS, let's try to understand what are the options you can explore for apart from ATC. Now, for ATC, apart from ATC, what you can do is you can go for health insurance premium that is covered under ATT, right? So in that case, what you can do is you can take up a medical insurance plan, and you can save either 25,000 rupees for yourself, and for your parents, if they are senior citizen, additionally 50,000 rupees. If they are not senior citizen, you can claim another 25,000. So let's try to understand this scenario. Let's say you have taken a medical insurance plan for you and your spouse and your children. You are paying medical insurance for these three people amounting to 20,000 rupees. Your parents, one of them is senior citizen and other is not. So in that case, for both the parents, it will be treated that they are both senior citizen, and the additional amount of 50,000 rupees will be allotted to them. Therefore, if you have taken a medical insurance plan for your parents, you can claim maximum medical insurance premium of 50,000 rupees. Now, if the parents are not covered under medical insurance, in that case, medical expenditure is allowed. Now, the amount of 50,000 rupees is still applicable for that medical expenditure. Furthermore, you can just go ahead and make contribution in NPS, that is National Pension Scheme. And if you are contributing the amount out of your own pocket, then 50,000 rupees additional you can claim under 80 CCD 1B. Again, let's try to understand this situation with an example. Let's say your EPF, Employer Provident Fund, is 28,000 rupees. You are investing in ELSS, let's say 90,000 rupees, and 96,000 rupees, 8,000 rupees of SIPs, and you are making a insurance premium payment, life insurance premium payment of 30,000 rupees. So we have seen that our total investment under ATC is coming to 1,54,800 rupees, out of which 1,50,000 rupees is deductible. Now, if you are investing in NPS, you can claim additional 50,000 rupees because you have invested in NPS. So, in that case, if you invest, let's say 30,000 rupees in NPS, in that case, your deductibles will be 1,50,000 rupees and 30,000 rupees, in total 1,80,000 rupees. In that case only, the amount is deductible. Otherwise, it will not be. Now, what else? If some differently abled person is present in your family, then you can easily claim 80DD, for which you can claim disability benefit. There is a blanket deduction for it depending on the disability level. If it is more than 40%, then 75,000. If it is severe disability, that is 80% or more, in that case 1,25,000 rupees. The same scenario is applicable if the taxpayer himself or herself is a differently abled person. However, the deduction will be claimed under a different section. Now, let's try to understand what are the smart hacks to increase your take-home salary. First of all, you need to claim as many deductions as possible from your salary itself, so that your taxable salary becomes less from the very get-go. So what are the ways you can take it? First of all, you can claim your HRA, you can claim the LTA. All these deductibles you can take away from your salary. Furthermore, if your organization is providing any reimbursement, maybe telephone bills, broadband bills, fuel bills, or books and periodicals, so that you can develop yourself in a much more professional manner, in that case also you can claim the reimbursement. Just check it with your employer once. If they give you this option, certainly you can go ahead with it. Further, you can have a discussion with the payroll department of your employer and see whether they allow to invest in NPS. If you are investing in NPS, or rather if your employer is giving you this option to invest in NPS, then you can save maximum up to 10% of your basic salary. Further, if your EPF contribution is capped to 1,800 rupees per month, you can voluntarily invest in Provident Fund on your own, and you can top up the contribution to PF. And finally, that is the most important thing. Make sure you are declaring your tax saving investment proof to your employer within a time frame mentioned by them. If you are not submitting the investment proofs, then you can see a huge amount of tax outflow in the last quarter of the financial year. Now, since we have understood the tax saving opportunities and understood the tax regimes, now comes the most important part, that is the filing of income tax return. Let's try to understand how we can file the income tax return using the ClearTax portal. First of all, you need to visit the ClearTax portal, for using the link that is provided exclusively for your organization, and you need to log in. After you log in, then a pop-up will appear, and in there you will be asked to upload your Form 16. Now, ClearTax has given you this option to upload Form 16 directly, and no need to manually input all the details. Once you upload once you click on the upload Form 16 button, you will be taken to a new page where you can simply drag and drop your Form 16, or you can choose to browse from your computer and upload the Form 16. Once you do that, the Form 16 data, the data that is appearing in the Form 16, that will be automatically pulled from it and displayed for you. And it will give you a message that the Form 16 has been read perfectly. After that, you will be taken to the page wherein you need to give certain basic details that is required to file the income tax return. First of all, you need to input the name, your date of birth, PAN, father's name, address, etc. in the personal information page. And after that, you need to upload or rather update the salary details, your address details as well. Once you do that, you will be taken to the income segment wherein you will be seeing what is the income that is generated from your salary income. It will contain all the details, the salary, the standard deduction, the TAN, the amount of tax that has been deducted. So all the details will be replicated. However, it is advised just go through the Form 16 once and this salary sheet once. Then we will move on to the deductions page, wherein if by any chance you have missed submitting investment proofs to your employer, you can update manually all the other details. So let's say you miss the window of opportunity presented to you in the month of January, right? And your employer has deducted a huge amount of taxes. However, you made tax saving investment in the month of February. So in that case, you will be able to input the details of those tax saving instrument over here in the deduction sections. Now, once you upload the Form 16, all the details on the salary will be picked from the Form 16 automatically, and it will be reflected on the tax paid pages. Just check and you can just go ahead. Now, if by any chance tax liability is arising due to, let's say, FD interest or savings bank account interest, which is more than 10,000 rupees, then you need to pay that amount of taxes and input the detail of tax paid challan, which will be reflected over here in the section called self-tax payment. If you have paid the taxes, once you make the payment, a challan is generated. You need to pick the challan details and put the entries over here. What are the details that is required from the challan? So BSR code is absolutely needed. The amount of tax that you have paid, that is also needed. The date of making the payment is needed. Also, the challan number, that is also very much important. Furthermore, going down the road, you will be taken to the tax filing tab, wherein you need to input certain details, the Aadhaar and the bank account details. Now, the Aadhaar is absolutely needed to file the income tax return for the person who are resident of India, or rather tax resident of India. And you need to input the details about your bank account, because in case you are getting a refund, the amount of refund is credited to the bank account that has been nominated for refund or the primary bank account. One small tip to remember over here is, if you are getting the refund, make sure your bank account is pre-validated in the income tax portal. If your account is pre-validated, then only the amount will be refunded back to your bank account. If it is not pre-validated, even after the tax return is processed and you have a legitimate claim of tax refund, it will not be given back to you because the account is not pre-validated and the department will try to process the refund, but it will not be credited to the bank account because it is not pre-validated. After that you will get to know what is the tax position. In this case, what we can see is there is a refund of around 4,000 rupees. It will be different for every one of you based on the incomes and deductions that you may be having. Once you get to the page, you can just go ahead to proceed to e-filing. Now once you go to the e-filing page, you will be asked to input or rather validate the income tax return using either of the method. One is Aadhaar OTP, another is Income Tax Department OTP. Now, as it stands, most of us has the Aadhaar OTP enabled. So you need to generate the Aadhaar OTP giving the details, and you can request the OTP and put the OTP over here and file the income tax return. In this way, you can easily file the income tax return using ClearTax portal. Now, after filing the income tax return, one key and very important work remains for you, that is to e-verify the income tax return. Now, once you file the income tax return, you need to e-verify it. So let's try to understand what is e-verification. E-verification is the process that, or rather is the action that lets the department know whatever information you have provided in the income tax return that is true as per according to you, and you are authorizing the income tax department to go ahead and process the income tax return. Without this confirmation, income tax department will never process the income tax return, and after filing, the e-verification needs to be done within 120 days of filing the tax return. If you miss the date, then it will be the income tax return that has been filed that will be taken as invalid tax return, which would mean that as if you have not filed the income tax return at all. So all the time that you have invested to file the income tax return, that will go to waste. So filing the income tax return within 120 days, you must e-verify the income tax return. Now, we are at the end of our session. Thanks for joining with us. Now we are going to have some question and answer. The question are popping in that I can see. Let's go to them. Okay. Lavanya is asking how much we can claim under 80 CCD 1B. Now, under 80 CCD 1B, the maximum amount that can be claimed is 50,000 rupees. And for that, only one option is present, frankly, that is NPS, National Pension Scheme. If you are investing in National Pension Scheme, then only you will be able to take benefit under 80 CCD 1B. Now, how to e-verify? E-verification is generally done in the income tax website. There are few steps in which you can do the e-verification. The easiest thing is to go into the income tax department, log into your portal, and if you have filed the income tax return, it will show in the dashboard that e-verification pending. You need to click the e-verification and you can choose to verify your income tax return using Aadhaar OTP. Okay. Mahesh is asking 44 ADA is applicable for IT employees. Well, Mahesh, 44 ADA is applicable for the independent contractors who are not in employment. Right. So if you are in an employment, that means you have a agreement of employment. If this is the situation, in that case you cannot go for 44 ADA. If you are an independent contractor, in that case, and you are not bound by employment contract, then you can opt for 44 ADA. Well, Swastik is asking if I have selected old resume, new resume, can I go for old one coming year? Yes, you can certainly switch between the regime each of the year, provided you are not having any income from business or profession. If you have any income originating from business and profession, then it is one time selection. If your income does not comprise any income from business or profession, you can switch between the regimes each year. Okay, Sumit is asking whether we can claim HRA with housing loan. Sumit, yes, certainly you can claim HRA with housing loan. Uh, if however the house is still under construction, then you cannot claim a housing loan, because housing loan interest is only available once the house in a livable condition, that is after you receive certificate of completion from the municipal department. After that you can claim, certainly, no, not a problem. Furthermore, there can be a situation wherein you have taken the house or a flat in your hometown and you are living in a different city, and for employment purposes you have taken up a rental place. In that case, certainly you can just go ahead, take HRA and home loan benefit. Okay. Now, okay, how to claim tax on on-site income? Okay, Kavita is asking. So, if you are going abroad, then we need to firstly determine what is your residential status. If you are a tax resident of India, then your global income will be taxable in India, most definitely. However, if you have paid taxes outside India, depending on the country you have visited, the amount of tax you have paid there can be claimed in the income tax return filing. But for that, you need to submit a separate form along with income tax return. If you do that, then the FTC will be given to you. Foreign tax credit will be given to you. Okay. Sindhuja is asking, I have missed submit HRA with my previous employer. Is it possible to claim it? Yes. At the time of filing the income tax return, you can certainly claim it. But for your present employer, it will be counted from the date you have joined them. But at the time of filing the income tax return, you can actually claim the actual amount of HRA that you are eligible for. Shoikat is asking, health insurance premium is 23K and my parents' health insurance premium is 47K. Can I save? Yes, in that case, you can save up to that amount. That is 23 plus 47. That is coming to 70,000 rupees. Yes, you can certainly save that. Okay, employer is deducting NPS 3,700 rupees per month. It is recommended to invest 50,000 rupees from mine. Right. So if your employer is deducting 3,700 rupees per month, that is a deduction that is given to you under 80 CCD2. However, the 50,000 rupees that we have discussed about, that is if you are contributing in NPS on your own. Right. So if your employer is deducting 3,700 rupees, certainly yes, they can do that and you can claim that amount in your income tax return. But if you also invest 50,000 rupees, that can also be claimed in the income tax return. Jense is saying, if I submit investment proof to employer, then do I need to follow these steps? Well, if your employer has considered everything, every investment proofs, then there is no need for it if the Form 16 has captured every detail. In that case, you can simply upload your Form 16 and go ahead with the filings. Okay. So insights on LTA, right? So LTA is a leave travel allowance. So as per Income Tax Act, if you are traveling within India using air travel in economy class, or if you are traveling through train using AC three tier or AC first class route using these two segments, then you can claim the air fare or the train fare for the shortest possible distance. For example, if you are staying in Bangalore and if you are visiting your hometown, let's say that is in Mumbai, in that case, the train fare or the air fare you pay to reach Mumbai, that is your hometown, the amount can be deductible. This deduction is applicable for you, your spouse, and your dependent children, and you can claim to and fro expenses. However, it is you cannot claim the hotel staying expenses if there are any. You cannot claim cab expenses if you are there are any. Furthermore, in a block of 4 calendar years, you can claim LTA for only 2 years. Now, the new block has started from 1st January of this year. So you have another 2 years to claim it. You have 2 years to claim it. However, if there is any unused LTA, or rather you are claiming LTA for the first time in this block, then you can claim 3 LTA exemptions for this block. But going forward from the next block onwards, you will be able to claim only 2 LTA components, 2 LTA amounts. Well, Megha, you need to contact the HR department or payroll department so that you can understand whether they are allowing or not. I mean, yes, certainly you can save more than 1.5 lakhs. You need to invest in the right tax saving instrument. You can invest in medical insurances, or you can invest if you can donate, then certainly you can get that. You can invest in NPAs on your own. You can invest in NPS through your employer. So there are multiple ways, multiple avenues you can save the taxes. You can, I can just give you the section number 80D, 80CCD 1B, 80CCD 2. All these options are available for you. Home insurance premium is not deductible as of now. It never was. In future, what will happen, we cannot predict. Okay. So short-term capital gains from shares. If it is at all short-term capital gains, it is not intraday. The tax rate is 15% on the gain amount, right? So on that gain amount, on that tax amount rather, you need to include the education cess and surcharge if it is applicable. So in your case, I don't think the surcharge is applicable. So 15% as tax, plus on top of that taxes 4% education cess. However, there might be some interest coming in your hand as well. So be mindful at the time of filing the income tax return. Well, unfortunately, we are at the end of our session. Our time has ended. Thanks for joining with us, and hopefully, we have cleared some of your tax related doubts and explained the process on how to file the income tax return using ClearTax portal. And one small thing I wish to say, the income tax return filing due date as of now is 31st of July. Do not wait till that date. If you have received all the documents that is needed to file the income tax return, just go ahead and file the tax return so that you can avoid the last minute rush. Thanks for joining.